Before we start today's show, I just wanted to mention our sponsor, Wealthify. Wealthify is regulated by the FCA and is a multi-award winning online and app-based investment service founded in 2016 and owned by Aviva, with a simple mission to make investing accessible to everyone. You can invest from as little as £1, and Wealthify offers a number of investment products, including a stocks and shares ISA, a general investment account, and a personal pension. However, Wealthify also offers a junior ISA, which allows parents to save for their child's future through investing. Wealthify also offers ethical junior ISAs and the ability for family and friends to pay directly into its junior ISA account for the child's benefit. In the run-up to Christmas, this could provide a meaningful and eco-friendly alternative to present buying. With investing, your capital is at risk and you could get back less than you put in. For more information, head over to moneytothemasses.com and search Wealthify.
Hello and welcome to episode 349 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leaks. Damien, welcome back. How are you doing?
I'm good, Andy. I'm wearing my Christmas jumper as we speak. You're not, I noticed, but we've had Christmas jumper day in the office. And if you want to go on Instagram stories, you can see our Christmas jumpers for those of us that were in the office today. And you can vote on who's got the best. So just vote for me.
The reason you kind of chuckled there is I'm still nursing a calf injury at home. And the reason I'm not in my jumper, I don't mind admitting it. Look, we've all been in lockdown throughout various stages of the year, and I've eaten too many pies, so I can't get into last Christmas's jumper.
I shouldn't laugh at that, Andy. I'm not sure if I should sympathise. I think Andy actually described it looking like it was made of lycra if he was who had to put it on. But
I might treat you to it later to show you what it really looks like. But the thing is, I am absolutely terrified because you're all over socials at the moment that it will just arrive on Instagram and almost immediately I send it to you.
No, this will be between you and I, Andy. I wouldn't want to put that on the rest of the world. But apart from Christmas jumpers, I've been pretty good. I've been up and down to the vets this week. That's the only negative. So my poor cat Bella, who I talk about every now and then on the podcast, she's 17. She's having a few health issues. So I seem to be spending a lot of time and money in vets at the moment this week. So that's the slight downer, but hopefully, fingers crossed, she gets better. But how are you, Andy? The calf is getting better, I hope.
Yeah, we're only a couple of days away from me being able to get back into the office and hopefully retrieve my car, because part of the issue of me injuring myself at work is I had to get a lift home, and so my car's currently stuck in about 40 miles from where I live. The quicker I get fitter, the better, really, for everyone concerned.
Right, so let's crack on with the podcast. There's 3 pieces this week, and Andy, you're going to be doing the last piece, but the first piece I'm going to be doing was actually inspired by Instagram. So on Instagram, I was asking for ideas for my 21-second video. So if you don't know, what I do is at the moment, I'm putting daily videos on the Instagram stories of me explaining something money related in 21 seconds. And obviously, as you'd expect, I go ambitious on some of these things. And somebody asked me, could I explain the 60% tax trap in 21 seconds, which I will inevitably try and do. But what I thought is we'd do a piece on the podcast because it does need a bit more than 21 seconds to explain what the 60% tax trap is, because it impacts more than just the wealthy people. There are 2 occasions where you can get caught by it. So quite a few listeners will be being caught by the 60% tax trap, even if they're not aware of it. And I want to explain how you can avoid it, what you can do to mitigate that. The other thing I want to talk about is a bit of investment research that was inspired by something I did for 80/20 Investor. I want to talk about the best asset mix for a portfolio for the pandemic. So looking back over the 2 years that we've been in a pandemic, so the bit just before and all the way through the pandemic, right up until now when we've discovered the new Omicron variant. There's lots of rotations in markets backwards and forwards. So I want to look at, was there a consistent asset mix that would have been good for the COVID pandemic? So that would be quite useful going forward. And Andy, the last piece you're going to be doing regarding scams.
Yeah, it's that time of year, unfortunately, where some of these scams are coming to a head and lots of national newspapers are reporting on various types of scams. So what I've done is I've brought them all together and I'm going to reveal sort of 3 or 4 of the most popular scams at the moment and how you can avoid becoming a victim this Christmas. So let's get on with the podcast then, and let's start with this 60% tax question that you were asked to provide a 21-second video of, which I'm sure you're going to do. It's going to be a tough one to fit in 21 seconds, I'm sure, but we're going to do it on the pod now, and there's no time restrictions, Damien. Off you go. What have we got?
So the 60% tax trap occurs on 2 occasions, really. So there are those of you who may have heard of it in relation to people who earn over £100,000 a year. So I'll go into a bit more detail, but those people can start to be taxed at a 60% rate, an effective rate. But there are things you can do to mitigate that. But there are people who will also earn a lot less who can be hit by an almost 60% tax charge. Now, if you look at the number of people that have been potentially impacted by these tax traps, then that totals more than 500,000 people. So if you take that number, that means there's going to be quite a few people listening to this podcast that's been impacted. So what I'm going to do is start with probably the most likely way that listeners are getting hit by an almost 60% tax charge. Now, if you've got children and you are claiming child benefit, then if you earn over £50,000 or your partner does, then what starts to happen is you are liable to a tax charge called the high income child benefit charge. And what that means is that for every £100 that you earn over £50,000, then you lose 1% of your child benefit. And it has to be paid back in a tax charge. So what typically happens is somebody is claiming the child benefit, then by the time they hit £60,000, then they would have to have paid all of it back when they do their self-assessment. And so there are many people who don't realise this. They might get a pay rise or a bonus that tips them over the £50,000 threshold, and therefore they have to pay this high income child benefit charge. Now, I want to give you an example as to why it works out to be a 60% charge. Imagine if you have 2 children and you get child benefit for them. For the first child, you'll get £21.15 a week. For the second child, you currently get £14 a week. Times that by 52, that equates to £1,827.80 that you receive in child benefit a year. Now, let's say you earn £1,000 over the £50,000 threshold, then what it means is that you lose 1/10 of your child benefit. It's going to have to be paid back as a tax charge. And that obviously equates to £182, just rounding it down. Then don't forget, in addition to that, you're going to start being charged income tax at 40% on anything that you earn over £50,270. That's the tax band. So above that, you start paying 40% tax. So just for ease, because it makes it simple for people listening to this, let's just round that to £50,000. So as you start earning money above the £50,000 threshold, you are going to start having a tax charge, but you're also going to be paying more income tax. So let's say, for argument's sake, that you earned £1,000 above the £50,000 threshold, then you're going to pay £182 in the high income child benefit charge plus £400 in income tax, which if you add it together is £582, which equates to 58.2% effective tax rate. Now again, obviously the band for income tax at 40% is £50,270, but you get my point. If you keep earning money above that, all the way up to £60,000, then you are paying effectively a 58.2% tax charge. Call it 60%. The other time you can get a 60% tax charge is if you earn between £100,000 and £125,000. And again, it could be that you get a bonus that takes you over that £100,000 threshold. And the reason why, again, there is an effective tax rate of 60%. And of course, when I say effective on both of these examples, you're not being charged a 60% tax band. It's just when you work out the amount of money that you've got to pay in taxation, it equates to 60% on that portion of your money. So what happens if you earn over £100,000, you pay a 60% effective tax rate because your personal allowance goes down by £1 for every £2 that your adjusted net income is over £100,000. So that means that you have no personal allowance if you earn £125,140 or above. And now don't forget, your personal allowance is the band that you have which is tax-free, and that's £12,570. So that first £12,500 of your income currently you don't pay tax on. So if you earn £101,000, so you've gone £1,000 over that 100k threshold, then on that additional £1,000, of course, you're paying 40% income tax anyway because you're in that bracket, because you earn over £50,270. But because you've lost £500 of your personal allowance, because do you remember I said you lose £1 for every £2 over £100,000 that you earn, then that £500 is taxed at 40%, which obviously equates to £200. So if you add the 400 and the 200 together, you get £600 tax that is effectively paid on that additional £1,000 that you've earned above the £100,000 threshold, which equates to a 60% tax rate. That's how it works. So all you need to know, there are two scenarios where you can start paying an effective 60% tax charge. So what do we do to stop it? Now, if you go and think about the child benefit example, it's important what counts as income. And they talk about adjusted net income. And that is actually what you're assessed on. And it's the total taxable income before personal allowances and less the likes of gift aid. So it's the gross earnings, but less things like gift aid. And so if you had a £60,000 adjusted net income, then that's when you'd lose all of your child benefit. But one thing that is also taken out of adjusted net income that isn't counted is pension contributions, and they're gross pension contributions. So if you had £60,000 income and you paid £8,000 into a pension, which is grossed up at the basic rate, if you remember straight away, to £10,000, that takes your adjusted net income, which is what they look at, to £50,000. And then that means that you don't lose your child benefit. So what happens is people who might get a bonus that takes them over that threshold of £50,000 may decide instead to pay that money into a pension so they don't lose their child benefit. Yes, the money's now going to be locked into their pension, which they can't access until they're age 55. And don't forget also that you will be able to claim back tax relief at 40% on that pension contribution. So you've already got 20% straight away when you paid the £8,000 into the pension. It's automatically added to make it £10,000, but you can claim the other 20% via your tax return. So that is one way to mitigate it. Another way is to split your earnings if you can across tax years, so you'll be able to mitigate the amount you earn in a given year. Or you could try and shift your income in some way. Let's say you had income producing investments. You might be better off putting them in your partner's name, because somewhat unfairly, people could earn as a couple almost £100,000, just two pennies short of that, because it's split down the middle, that they both earn just under £50,000 each, and they would keep their child benefit. But a couple where one of them wasn't earning anything and the other person earned £60,000 would lose all of their child benefit. It is an unfair system, but they are the rules. So you could try and mitigate it by moving income assets around. The other thing you can do is obviously salary sacrifice, where you give up a portion of your salary in exchange, for example, a pension contribution. And that will not only help mitigate the tax charge for the child benefit, but you also save on national insurance, as can your employer. Now, I'm not going to dwell on salary sacrifice because there are pros and cons, but go back and listen to podcast 85 where I talk about it, but also podcast 339 where I talk about bonus sacrifice, again with the pros and cons. And the other thing you can do is also give gifts to charity, because that can help reduce your adjusted net income. So moving on to the scenario where you earn over £100,000 and you start to lose your personal allowance, how you mitigate that is basically the same way as you would with the child benefit tax charge. You can use pension contributions. So somebody who was earning over £125,000 could put in a large pension contribution to therefore bring their adjusted income under the £100,000 threshold. They therefore keep their personal allowance. And again, there are pros and cons of doing this. But for people who earn that much amount of money, they also could be interested in carrying forward unused pension contribution allowances from the previous 3 years. So that's an additional £120,000 worth of pension contributions they can pay on top of the 40 they could pay in the current tax year, which they could therefore use to bring down that adjusted net income. But not only that, because it's a sizable number, some people do use it to reduce their tax bill more widely. Because if you think about it, if you earn over £150,000, you are into the 45% income tax bracket. So some people would use the carry forward unused allowances to make really large pension contributions, which can then therefore bring down effectively their tax bill because they can claim that higher rate tax relief. But I'm not going to go into too much details, but they have to have been a member of a pension scheme as far back as they want to be able to carry those unused allowances from in the 3 previous tax years. But they also have to have enough earnings in the current tax year to be able to have paid the tax that they can reclaim. The upshot is that if you made a pension contribution of £160,000 in total, then someone who's a 45% taxpayer could claim up to 72 grand in tax relief. So that is it, Andy. It would have been difficult to explain in 21 seconds. I am still going to give it a go on Instagram stories, so do look out for that in the future. But what I want you to highlight is that there are quite a few people who will start to hit this 60% effective tax rate that occurs, and they may be happy with that, but there are things they can do about it.
Okay, so moving on to the next piece then, and this next piece sprang up from a piece of research we were doing, Money to the Masses, for 80/20 investor members surrounding an asset mix that may be right for what's going on with the ongoing pandemic at the moment. And Damon, you've got a bit more to talk on the podcast about this.
Yeah, so this is something that's an offshoot of what I did for 80/20 investor members. So just to clarify, what happened is I sat down and thought about Omicron and how can you invest in a world where Omicron comes along and just pulls the rug from under bond markets and equity markets. And if you go back to our midweek market shows, you would have heard me talk about the impact of Omicron and how we've seen rotations back and forth from different assets. So suddenly defensive assets become more popular rather than the more aggressive cyclical assets. And what we've seen throughout the pandemic are waves of this. We see periods where defensive sectors do well or defensive asset classes like bonds might do well, but then it becomes very much risk on and people start to rotate out of those defensive assets into cyclical things like financial stocks, which then start to outperform. And then if you ride that wave, you can obviously make a handsome profit. But then again, we get another news headline. Maybe it's about the efficacy of a vaccine, or in the case of Omicron, another variant comes along that people are worried about. And the things that were winning yesterday suddenly are at the bottom of the performance tables. And it's very difficult to invest in that environment because things swing wildly from one way to the next. So what I wanted to do is I was looking at, well, is there like a core to your portfolio that you could have, that you could decide around the core to have these satellite positions, so you could try and boost returns by picking certain types of investments that you might want to ride the unfolding trends. But there's a core holding that you have that may be multi-asset in nature. So it holds things within it that could be things like equities, bonds, property, commodities, or other alternative assets that has been a steady eddy throughout the last 2 years. And the reason I said 2 years is because it was before the pandemic. It was therefore during the biggest collapse in equity markets and the fastest bear market we've had, I think, pretty much in history, but also the economic shutdowns and recoveries, the vaccine discoveries, and of course we've had the new variants. And on top of that, we've had central banks toing and froing about what they might do with monetary policy. So in order to try and work something out, I wasn't just looking for what made the most money, because hindsight's wonderful. And I could just sit there and say, well, the best thing you could have done, given where markets are now, is just buy an S&P 500 tracker, for example, or a certain type of US equity fund or equities more globally or something. Because I know with hindsight the central bank stepped in and basically flooded the market with liquidity. That isn't useful, because if we get another event that's similar to what we've seen over the last 2 years, and we don't know what's going to happen with the pandemic, we don't know how it's going to unfold, whether we're going to have something like Omicron is going to be completely disastrous or another variant. And in that uncertain environment, you therefore want something that was not only consistent in terms of performance, but also didn't take undue risk. And any risk it did take as a fund was rewarded. So I started to look at, is there some sort of steady eddy core multi-asset funds that should be in your portfolio that could help steady the ship while things are just going crazy around us with the pandemic? And what I did is I focused on 3 metrics, really. It was the performance on the one hand across the entire pandemic of funds. But more importantly, I also looked at volatility. So that's the amount that the asset price has gone up and down for the particular fund. But also something that I'm quite fond of, if you can say that about a statistic, is the Sharpe ratio, which is a mathematical number that's calculated that effectively shows the amount of reward for the excess risk that a fund manager might take. So basically, the higher the number, the better. So they're getting rewarded for that excess risk that they're taking. And I looked at that for a range of multi-asset funds. And in fact, it was over 770 of them, because they don't exist in one sector. That's the difficulty when you're trying to look at something that's multi-asset, because obviously in uncertain markets, you want to diversify. And that normally means holding lots of different type of assets. Now, if you've got a core holding that's got a bit of everything in it, that's quite handy. I first did research in finding those 770 funds, given that they're not automatically isolated into a nice sector, which would be useful. I then drilled down and looked at those particular metrics to look for that consistency in performance, and that they also outperformed their peer group. So by looking at those key metrics, I was then be able to rank the various multi-asset funds, and I could look for those that have performed the strongest and most consistently throughout the pandemic without taking unnecessary risk. And I came down to a short list of 24 funds, which I'm not going to run through on the podcast because that's for 80/20 investor members. But there is some interesting insight that I can share, and that is the average asset mix of those funds, because it's quite interesting to see, while these funds won't have been the top performers in their sectors, they outperformed their peer group averages, but how were they split? Because to give that consistency of performance. And so I'm going to cut to the chase. And the answer was they were split 59% on average in equities. So when I say on average, some will have much more than 59% in equities, some much less. But on average, 59% in equities, 10% in alternative assets. So that would be things that would be classed as that targeted absolute return funds. 4% in commodities and energy, 12% in bonds, 6% in cash, 3% in property, and 6% in what it actually is unknown. So you could pretty much sprinkle that across the rest of the group. And the reason there isn't always an unknown is because fund managers, when they report what their fund holds, sometimes it doesn't fit nicely into a category. And that shows that a 60-40% split is a decent starting point in this pandemic for a fund. And if you're building a portfolio, that would have been a pretty decent portfolio for this pandemic. But it would have been better to diversify that 40% of defensive stuff into other areas too. So that would be alternative assets. Now, the commodity and energy and the property, you could argue, is to a certain extent equities. And in most funds, that's what it would be. So that pushes the potential equity content up to around about 65%. So that gives you a steering that that's the sort of level of equity content that has done quite well in this pandemic in terms of consistency and not taking excess risk. Because don't forget, there's been some wild rides in this pandemic. So if you'd been 100% equities, you would have been probably sitting there quite nervous at some occasions. And one thing I just want to finish on this piece is that only 12% of that would have been in UK equities. So 12% of the portfolio in UK equities is quite low, given most people's portfolios that are in the UK. There's always a UK bias, and the answer was to be more global. So there we go, Andy. The perfect portfolio for the ongoing pandemic.
Okay, and so let's move on to the final piece of the podcast then. And I'm just going to be covering off some of the scams that have been doing the rounds of late. There's been quite a lot in the news. And so I'm just going to cover off 3 or 4 of the scams that have hit the headlines this week, just really to make people aware of them and that they can tell other people, and we can spread the word and hope that these people don't succeed in stealing your Christmas money. And so the first one I'm going to cover off is the child in need scam. And what this is where fraudsters trick money out of parents by posing as one of their children. It's quite a clever scam in the sense that obviously mum and dad are just called mum and dad. So they can fire off thousands of these messages to numbers that they've harvested with a fairly simple message, really. It's not particularly sophisticated. It simply says something like, "Hi mum," or "Hi dad, I've lost my phone. This is my new number. Can you text me back?" And it's normally via WhatsApp that this is created. And what then happens is a conversation happens, they gain trust, and they try and make it look like one of your children is stuck, they've lost their phone, and it's an introduction to try and wire some money over to them via banking. As I say, it's a fairly non-sophisticated scam, but it can be very convincing and very easy if you have got a child that's often losing their phone, or if you're worried about them because they've they've been going out to Christmas parties or whatever.
Or travelling, I suppose, as well, Andy, because they could be travelling and they could be wanting money, couldn't they, and writing back to you. But one of the things I have to say, Andy, who knows me well, if anybody went through my phone, they would be sitting there searching for mum and dad, and they'd be going forever because in a weird quirk, it's not me trying to protect myself against such scams, but my brother and I don't call my mum and dad, even though they are our real parents. I don't know what happened. I think when we were about 15, you know when kids call you by your own name, and as a parent you find that irritating? Well, my brother and I thought that was hilarious. So basically for the last 30 years, we've been calling our parents by nicknames, and we still do to this day. So they're in our phones like that. So the other thing you could do is stop calling your mum and dad, and just give them nicknames like when you were at secondary school.
Yeah, exactly. And another quick and easy way, if you receive one of these messages, because obviously what you don't want is if it is your child that's in need, you don't want to assume they're a scammer and not help them out. So you can use code words, you can set those up beforehand. You can simply ask them, if it's via WhatsApp, ask them to send a voice message. Obviously you're going to be able to recognize their voice, or you could ask them a question: what's your middle name, what's your date of birth, or something, just as an extra layer of security. At the end of the day, just make sure that the person who's at the other end of that message is the person you think it is. So moving on to another couple of other scams then, one of the most popular ones, especially around Christmas time, is the "you've received a parcel" or "we've missed your delivery" type text or WhatsApp. Generally this one's on text, because when you're buying products, you're often asked to put in your phone number and we'll text you updates of your delivery. So there'll be messages that you receive purporting to be from people like DPD, Yodel, Hermes, and because you don't know what those numbers are, a random number could seem very genuine, especially if you're expecting a parcel. So things to be aware of: if you're being asked to click a link where you're asked to provide more information, be very wary of that. None of these delivery firms will be asking for extra information. At the end of the day, they've got your address, they've got your phone number. Don't be tricked into giving extra information, because what that type of scam is, it's a way of harvesting extra information. And just to give you a bit more insight into the way these scams work, they're fairly sophisticated. What will tend to happen is you'll then receive a phone call pretending to be from your bank saying, "Oh, it looks like you've submitted some additional information on a scam text. We're from your bank. So what we're going to do is we're going to protect you now, and we're going to ask you to move the money into a safe account." Now, of course, they're the scammers that are then saying that. So it's kind of working on a trust basis. Just be careful of that. Don't fill in any information. If you think that you've missed a delivery, then go into where you originally placed the order. Check your emails, go into the website that you ordered it from, and check that way. A final one that I just wanted to cover off before I give a tip is what they call a cash trap scam. Now, annoyingly, I've actually been caught out by this one. This is where there's a device fitted to the actual cash point. Now, we're all using cash slightly less these days, but there's no getting away from the fact that every so often you'll have to go to a cash point. Now, around Christmas time, you don't want to be caught out on this. So the way this scam works is there's a device attached to the cash point itself, and it's very difficult to see, and it effectively blocks off the cash from being able to dispense. So you put in your card, you put in your number, the machine beeps, you select how much you want, and then for all intents and purposes, the money is there. There's a message on screen saying, "Please take your money," but the money hasn't actually arrived. It's not showing. And so what often is the case is there'll be a cash trap glued to where the money is dispensed that you're unable to prise away. It's actually been fitted by the scammer. You are then assuming that there's something wrong with the cash machine. You walk off. You'll have your card because it will spit your card out before you get your money, if you remember the way that it works. And you'll walk away scratching your head, and you'll probably contact your bank and say, "Hey, there was something wrong with that cash point." There'll often be a scammer hiding around the corner. They'll nip up to the cash point, prise the trap away, take the money. They'll reset the trap, and on we go again. I was caught out by this a few years ago, but I was actually alerted to what it was, and I couldn't prise the trap away from the machine. I could see what was happening, and so I hung around trying to see if I could catch the person who was doing it, because I knew there'll be someone actually waiting to watch me walk away to take the trap away. Anyway, it didn't happen, and I ended up losing my money in that case, which is a real shame.
Well, so you actually you waited and they didn't come back. What would you have done? I mean, that's quite one of those scenarios you don't know quite what you would have done, would you?
Yeah, I was a little bit passag, I suppose is the word, because I realised what it was. I could see that the trap had been glued to there. I tried to prise it away with my fingers. I wanted to get some kind of a knife or something to prise it away, because I thought, I'm going to take this as evidence, but I couldn't do it. It'd been really glued on there tight. And so I started shouting like some prized idiot. Really, I started going, "I know you're there. I know what you've done. You're waiting for me to leave. I'm going to wait for the police."
You sound like my sort of toddler. I know what you're doing. I don't love you anymore. That's brilliant, though. I mean, that would have been infuriating if somebody had done that and you knew what was going on. And I called. Did you get your money back?
No, I called the bank. I explained what had happened because, as far as the bank were concerned, the money had been withdrawn. I could have followed more procedures. What I should have done is I should have filled in. It was £20 at the end of the day. It was a Friday night. It was to get a takeaway on the way home, and I was annoyed I was going to miss my train. So I ended up going home. I knew what had happened. It was only £20. I contacted my bank, and then they asked me to fill in the various forms and everything else, which is as they should do. They followed the correct protocol. The long and short of it was, for the sake of £20, I looked at my time and how much it was worth and just didn't bother proceeding. I'm sure I would have got the money back because there would have probably been camera footage of me not being successful in actually taking the money out of the machine. And just finally, to finish off this point in terms of the scams, there are a lot of scam emails that you'll receive and you'll see them come through and you'll think that doesn't quite look right. Make sure that you don't click the unsubscribe button on those emails. The best thing to do is, if you think something is a scam email, is to delete it. But before you delete it, mark it as spam, and then your email should start to filter those out. Don't be tempted to click the unsubscribe button at the bottom of those emails. And the reason being, you're effectively telling the scammer that you're a real human being, and it will actually almost certainly up the amount of scam emails you get sent, because your details will then be passed on, because your details will effectively then be sold on through the dark web, and it will spiral. So don't be tempted to click on that, because it won't do anything. If it's a scam email anyway, you're not going to be doing anything by clicking unsubscribe. Just delete it, mark it as spam, move on. It's frustrating, but that's what it is. So that's it. There's a roundup of the scams that are going around at the moment. Please don't get caught out this Christmas.
I mean, that's a great last tip, Andy. Actually, I haven't really thought about that. But so that's it for this week on the Mountain Masters podcast. As ever, do please leave a review if you want to get in touch. Do follow us on all our socials as well. So Instagram stories is where we're at. We're going to be doing a lot more on our social channels, particularly Instagram. So do keep sending in your suggestions as well for the 21-second videos that I'm doing, because I will continue doing those, I think, beyond this Advent period and into the new year, because they are proving incredibly popular. Actually, on TikTok, people on TikTok seem to like videos that last only 21 seconds. So please leave a review. And that is it, Andy. Until next time.
Until next time.